So, welcome everyone. It is 12 p.m. Eastern Time. You are in for a treat today. We are getting ready to have our webinar today with it's called Leverage Life Insurance. My name is Michael Mandarino. I'm the owner and agent with 123 Life Insurance. We work with the ultra high net worth individuals to help them navigate leverage life insurance. I'm a 1996 graduate of the United States Military Academy. I've been a life insurance agent since 2002. So we got our team today. So I'm going to go ahead and get out of the way and introduce Colin Steinbergs. Colin, go ahead, take it away, please.
Yeah. Well, thanks everyone for joining. That was a great introduction, Michael. Uh, First and foremost, this is a couple times we've done this presentation now, and really have met a lot of great people throughout. This is kind of a high level concept, certainly something that's a bit unique in the space. We have different levels of ways to use leverage. So if you think maybe I'm not sure I qualify for one thing or I don't qualify for another, there's certainly conversations to be had, and there's a lot of opportunities for different people at different levels of wealth. So I'll kind of start there, but excited to have everyone on the call here, and look forward to this presentation. So first and foremost, I just wanted to also mention that the best conversations here will be kind of after the fact. So we're really happy to be doing these presentations and getting a lot of information out to many people at once. However, the real conversations happen behind the scenes, and we can get into much more detail. So this is really just meant to be a surface level type presentation. So
And also some housekeeping methods. You can also please feel free to use the chat and or ask questions, and we'll answer those at the end. We definitely will have a Q&A session for those who are on board. In fact, we'll allow you to even come offline. But yeah, so looking forward to it. So Colin, thanks again.
sure. So uh, first and foremost, I've been working in this space for over a decade now, working with a firm called Schechter as a employee and now indirect employee. But we've been doing premium financing policies for 85. Well, we've been doing premium financing policies for over a decade. But the firm itself and insurance policies we've been doing this for 85 years. So really, really deep into understanding the insurance marketplace as a whole. Um, and we have a lot of volume that we do. So we are a big player in this space in general. So just a little bit out of our firm here. Huge team. Everything that we do here, I think, is special because we have a massive team behind us. As you can see, all these people are involved in single transactions, and it really does take a village. We are much more of the thought that we'd rather spend the time, money, and energy in R&D, understanding the marketplace as better than anyone else out there, and really deliver high quality opportunities in doing so. So this is our team. These are all the folks that go into making some of these transactions happen. So just quick overview on life insurance. I'm not sure how familiar everyone on the call is with life insurance, but there's a reason we use life insurance, and that's because it has a bunch of tax advantages. If there were other products that had tax advantages like life insurance, I can assure you we'd be talking about those too. But life insurance has been created through many different things, legislation that has made it this awesome kind of tax advantage structure where we can really use it as a tax wrapper for different designs. So when the insured pays the premium with after-tax dollars, all those tax dollars grow tax-free. Any dollars that come out of an insurance policy can be accessed with tax-free withdrawals, and death benefits are paid tax-free as well. So all these benefits, very much similar to a 401k. If you're paying with, or excuse me, a Roth 401k, if you're paying with after-tax dollars, you're really getting all these types of benefits. Many different types of ways to use life insurance. Here are just a couple. I'm not going to spend too much time on this slide, but we go well beyond just doing leveraged life. We have a lot of different strategies that might also fit. So it's not a one size fits all. It's important to remember that there could be many strategies that work. So a little bit about Leverage Life. Leverage Life has been around since 98. Essentially, we had a bunch of life insurance advisors and some smart folks who kind of understood that there was a direct correlation and arbitrage between interest rates and policy returns on IUL products. They looked and said, hey, we can basically use a bank or borrow an outside loan, collect an arbitrage, and reduce our out-of-pocket on life insurance by using lending on the premium. So that's been around for, yeah, like I said, since 98. We see a lot of, it kind of mirrors like a real estate financing type transaction. So it's very, I like to think of it like if you were to purchase a home, you normally would use a mortgage, even if you could afford the home without, by just paying cash, because naturally the asset typically outperforms the borrowing costs, and that's exactly what happens with these life insurance contracts. The good news is with these life insurance contracts, they're normally capped and floored, so they're very predictable from a return standpoint, which you can't necessarily say with real estate. Real estate could go down significantly in a single year. Life insurance has a protected floor. And because of that, banks absolutely love lending on this. If they had an option between something that could lose 40% in value and something that can't go any lower than zero, they're going to take the thing that can't go any lower than zero all day long. So they're really excited about lending on these insurance policies. We have lots of banks involved because of that. Um, so again, no market volatility, very low default risk as far as um, individuals who participate inside of these policies. And they also typically loan 100% loan to value on the cash value of life insurance. So they basically treat life insurance policies, the cash inside of these, at about 100% similar to like a cash investment, which just shows you how confident they are lending on life insurance. So couple common use cases. We will go into these a little bit more detail, but estate and legacy planning, we see people if they need insurance for estates, they might use leverage life to reduce their out-of-pocket. Tax efficient wealth accumulation, they might look at this as some sort of kind of investment, an alternative to fixed income, ways to kind of boost wealth accumulation long term. And then eventually use those dollars for, retirement purposes. As I mentioned earlier, you can take money out of these insurance policies on a tax-free basis. So it's a really, really powerful strategy for retirement planning purposes. We also see this a lot in executive and business strategies. So we see business owners who might need, say, a key man policy or a buy-sell policy, or maybe they're just looking for an exciting way to retain key employees. We see a lot of uses of leverage life in those situations. And then generally, we see this strategy that we're going to be talking about more specifically for clients with a net worth of 10 million plus. So there's kind of different levels to the different banks that are involved. For the highest level of, I'd say, the largest banks and the best interest rates, you're normally looking at 10 million plus of net worth. There's also strategies for those who are accredited investors that can also be considered. So just a kind of high level overview, and we use leverage life and premium financing interchangeably. Both words kind of describe the same concept. But when we see people doing this for an estate planning like purpose, here's just a little flow chart that kind of shows, hey, we have a trust who ultimately is doing the borrowing. So it might be a trust for on behalf of the individual. They do a loan arrangement with a bank, which is funded by the client, and then the death benefit ultimately goes tax-free to the beneficiaries. This is something that's more kind of high level or high level. So if we want to go into more detail, and if you're looking and saying, hey, how does leverage life possibly work for my estate planning strategies? This is something we dive much deeper in one-on-one conversations. Um, just a couple of numbers when it comes to leverage life, and I'm going to kind of fly through this a little bit so I save time for questions. But as far as our practice as a whole, we work with over 100 professional partners on leverage life opportunities, which means insurance brokers all over the country, all over the world are coming to us to work on these leverage life opportunities. We partner really well with other insurance brokers. financial advisors. We have all different types of people who we work with on these leveraged life, and we've built a lot of trust in the industry as someone who's really understands this space specifically. So typically, an average case takes about 12 weeks. We see a pretty much a 50-50 split between people doing this for estate planning purposes, where they might need more death benefit, and people doing this for retirement purposes, where they're looking at more cash value. Different kind of policies for different reasons, but all good and all very similar. So uh, over 250 policies managed. Average premium size is about 850K, and then we have 100 plus policies placed, and that's just in the last 18 months. So we're doing quite a lot of this business currently. This is a quick slide that I wanted to spend a decent amount of time here on to understand why do people use leveraged life. It's always helpful to kind of share some case studies. So the first case study I want to talk briefly about is we had a couple using leveraged life to maximize retirement benefits. So again, retirement benefits in a life insurance strategy, a lot of times we see people using them just like a Roth IRA. The nice part here is we don't have RMDs. We get all this money coming out tax-free. We have a lot of flexibility with the cash inside of a life insurance contract. So one example is we had a 50-year-old couple who was implementing a leveraged life insurance strategy as really kind of a diversified retirement asset. They had other retirement assets. This was a diversified asset with about $125 million capital commitment. The program was able to generate about $475,000 per year tax-free income from 65 to life expectancy. So they only put 125 million into this. They used leverage to significantly boost the amount of coverage and cash going into this policy. And then they were able to take income out of this policy all throughout retirement with a very small front end investment. And they did this at 50. Were able to take these benefits down the road at retirement age and had a lot of flexibility in their retirement because of it. If you did a similar strategy without leverage, same thing kind of works. But that number, 475,000, would be a lot smaller. And if you wanted that number to be around where it is today, you'd put it on a lot more capital commitment. Another strategy, as we mentioned a lot, people use leveraged life very often for estate planning. Estate planning is expensive. It's not only expensive from I have to put money into this, or, I really should say reallocate money. But it's also expensive in the sense of the opportunity cost of what this individual could be putting their money into elsewhere. So if an individual has, say, a business, or maybe they're really big in real estate and their money goes way further in real estate or whatever they're returning in a business, this is a really good way to spend far less, but still have this estate planning protection. So when someone dies and they're over the $30 million threshold of estate planning taxes, they are going to have a big tax bill that could ultimately be larger if that estate exemption changes, which I can assure you in our lifetimes it will certainly change. But ultimately, to have that cash immediately, especially for people in real estate and businesses where they're not in a position where they have to do a fire sale, life insurance is an incredible strategy that is always ensuring that that money is going to be available within a week. No other strategy out there can do that. It's tax-free. And that's why so many people are buying insurance for estate planning. We're really kind of, I'd say, maximizing the use of this life insurance by reducing the cost. In this case, specifically, we had a 6-year-old owner who needed estate liquidity. They were quoted about 10 million and 25 million for a traditional whole life policy. We used premium financing to lower that cost to about 1 million and boosted the projected death benefit from 25 to 44. So we preserved a significant amount of capital, and we left them with a lot more capital going forward. So that was another example. Oftentimes we have people saying, hey, I really like this concept and I have the money to do it. However, I'm probably, too old for life insurance. And that does happen. Typically, we see this as, I'd say there's a hard cutoff really at about 70 years old. After that, the numbers just don't make sense anymore because the cost of insurance is just too high. However, what we see a lot of folks doing is setting up these policies for kids, grandkids, which is a much cheaper person to insure. It's a great way for an older grandparent to fund something long term with additional arbitrage. Not a huge funding commitment, but long term these numbers can really take off, especially when you're using leverage for younger individuals. So we see a lot of people, 80s, 90s even doing some of these strategies, and then there's some other layers of loans and different things that we can do to avoid getting some of this money out of maybe the top generation's estate for estate planning purposes. So another strategy we can go deeper into. And then lastly, I mentioned earlier about using leveraged life in a business. We do this pretty often, but specifically we had two partners who needed about 50 million of coverage to fund their buy sell. This was a private equity group. They initially were looking at some term costs. It was somewhat cheap, but ultimately these guys needed estate planning coverage. They were ultimately at some point going to need this same 50 million to cover their estates. So we were able to show them how they were able to spend close to the same amount of money as they would on a term policy, on a permanent policy. And not only did this cover or has it covered their buy sell, but it's also going to transition into their estate planning. So they're not just getting an asset that expires worthless, and their dollars are going a much further by using leveraged life. So a couple of strategies there. Let's see. I'm not going to go too deep into this, but just high level, here are some of the ways that we show leverage life illustrations. In this example, we're showing, hey, this is what a non-finance, if someone, I think we had in the previous slide, a 50-year-old who was looking at about 20 million of insurance. Here's what it costs for about 20 million of insurance and some different ways to do that. We have 6 million and 5 million respectively for the cost of this $20 million insurance, about 4% IRRs. And then we have our finance life insurance, where we've probably reduced our cost about a fifth. We put $125,000 into the same type of policy, and instead of ending up with 20 million of death benefit, we ended up with 45 million of death benefit. Much higher IRR. This is really kind of the magic of financing. And then lastly, this was that $475,000 illustration for the individual who was doing this for retirement planning. Again, they put in 1.25, and then they were able to take out about $475,000 a year of tax-free retirement income.
So Colin, let's go back to the first one again, just to kind of reiterate, the power of this. So for those that are on there, this is non-finance. So typically, it's going to cost this individual about $6 million total to get a $20 million death benefit. And that death benefit is going to stay level. And then we are making an assumption that this is a preferred 50-year-old non-tobacco user. So, one of the things that Colin and I do in our team, we're going to individualize this for exactly who's on the call. We're going to make it exactly, we're going to go through a full analysis on our first introductory meeting to figure out, is it going to be the insurance going to be on yourself, maybe a spouse? Is it on the children? What are the goals? So again, just to show this is what the non-finance is. So that's $6 million out of pocket. If you're a real estate investor or you're investing somewhere else, I mean, that is taking out, $300,000 a year that you need to be able to put into this. And go to the next slide again, just to reiterate like how important that is, that in this case, we're only putting in 125,000 for 10 years. So we've significantly cut down from that $6 million to about 1.25 million. And we're still getting after, as you can see here, after the loan is paid off in year 10, there's still a $20 million death benefit that in this type of insurance, and index universal life insurance actually has the ability of growing. So of course this is a hypothetical, but we are looking at using projections. And just to reiterate, Colin did a great job here, but also just as in this case, that loan is being collateralized by the death benefit and the cash value. So in this scenario, that loan is just going to keep growing and growing and growing until death occurs, and then that's when the bank's going to get paid back. And then Colin, if you want to just flip ahead again, different strategies of how to use this is in this individual, we were looking for not only the early protection of that 20 million, but now they're 70 years old and they want to start spending it. So we're showing in year 19 paying back the loan from the bank. So it's about $16 million loan. Again, that same 1.25 million. And with time value of money, and again, this is a hypothetical, but from starting at year 20, we're now able to extrapolate about almost a $500,000 per year until their 88th birthday. And then what's really neat after that is there's still a tax-free death benefit. So the key with insurance is as long as $1 of a death benefit pays to the beneficiary, all the money that's earned inside this policy grows tax-free and tax-deferred. So again, Collins, just want to know if you had anything else to add to that.
Yeah, no, that's a great segue. Um, the segue that Michael kind of gave us here is this is very customized. So we're showing you very high level examples. But frankly, when we talk to people individually, we're having much more detailed conversations. So we're talking about taxation. We're talking about what your liquidity looks like. We want to look at your risk tolerance, different types of policies for different risk tolerances. Your net worth, of course, we mentioned how much leverage you ultimately want to put, which is your debt to equity ratio. We want to know your family dynamics. We want to know how this all fits into the overall plan, and that includes estate planning and your goals in that space. And then we, of course, want to look at, maybe if there's an existing banking relationship, this can look really attractive from a lending standpoint if you already have existing banking relationships who are active in this space. It's just a couple of banks that we use, major banks, pretty much for the most part. These are all very large banks, very excited to be in this space and offer very competitive rates for these types of arrangements. This is really kind of the last slide I really want to look at here. And ultimately, it kind of just tells you, hey, why does leverage life work? When we're looking at these types of IUL policies, ultimately, we're trying to get a spread between what these funds return. And again, as I mentioned earlier, the funds that we're typically investing the insurance in are capped and floored. So they're very volatility managed. You're not going to get anything crazy returns necessarily, but you're also being protected very much on your bottom side. So you have caps that change over time. You have interest rates that change over time. Typically, the interest rates and the caps have kind of moved simultaneously. The caps lagging a little bit behind, but as you see interest rates rise, we see caps rise, which is exactly what you're kind of seeing in this example. But ultimately, the spread is what we're getting. So the performance of the S&P in the capped, in the collared kind of scenario over the Fed funds SOFR plus 150, which is roughly where rates are today. So you see the spread over time. Since 2005, we've had about a 3.6% return over that over interest rates. So some years you'll see it's negative. Some years we're close to zero, and some years we're way ahead. Ultimately, that's left at about 3.6. We've had probably the 2005 to 2015 were a very good 10 years. We've had another decent 10 years in the last since 2015 as well. And we continue to see a lot of the policies that we've put in place over the past decade really kind of outperform our expectations, which is great and what we're setting out to do. So currently, SOFR is about 3.66, 3.64. Bank spreads anywhere from 1.25 to 150. So roughly all-in rates about anywhere from 5 to 5.10%. So we're right around 5. We've seen that go up and down. If you are interest rate sensitive, there are capped options and floored options on interest rates that you can certainly visit. And these are some of the cap options that we'd ultimately look at. So that's it. I'll open it up to questions, but our contact information is right here. I'm sure Mike will be following up with most of you. We'd love to have an individual conversation. Again, this was just meant to be a, hey, this is what the product is. This is what we're working on. Here's some of the strategies and the ways people use it. But the real opportunities happen and the real kind of learning, I would say, happens on those one-on-one calls. So, uh,
Yeah, and
again,
Colin, also we have Jordan on the line. So just with our team, we work with the estate planning attorney. So Jordan, if you want to come off video, one of the main things when it comes to estate planning, and I'll have Jordan kind of explain that is,
yeah.
of course, when I started in the industry, the estate exempt tax was only $500,000 back in the early 2000s. Now it's 30 million for a couple, and that could change based off the administration. So Jordan, you want to just introduce yourself a little bit and just kind of mention how we can build irrevocable life insurance trusts and what does that kind of look like for the folks that are on this call?
Sure, absolutely. Just to give a real quick background here, I actually started off my career as a tax and estate planning attorney for one of the large Detroit law firms. And during my 11 years there, became an equity partner and built up a practice area of using life insurance as an asset class to help drive wealth transfer, business succession, retirement planning strategies that we'd implement for our clients, and grew to love the area because, as you've heard from Colin, it is incredibly stable and predictable, and it gave us real confidence that we were going to be able to achieve the results our clients were looking for. And there are a lot of things that you can do from a trust standpoint in order to effectively have your cake and eat it too. Where we want to be, or a lot of our clients want to have the ability to benefit from the cash buildup inside of these policies, but at the same time don't want to have the exposure of having the death benefit included in their estate. And so there are certain types of trusts that you can create where it is irrevocable, it is outside of your estate, but there are still ways that you can benefit from it. Sometimes people will have their spouse as a discretionary beneficiary of the trust, so that if they need or want money back out of the trustee can distribute it to the spouse who can then share it with them. You can also empower the trustee to make loans back to the grantor, um, which, because the trusts are typically ignored for income tax purposes, even though they're respected for estate tax purposes, those loans don't have any income tax consequence. And then for certain clients, if you are domiciled in the state that allows for it, and I think we're up to about 19 states that do, there is a certain kind of trust called a domestic asset protection trust, where the grantor can actually be a discretionary beneficiary of the trust. So in that case, you can personally, if you set the trust up, still receive distributions as a beneficiary, but while the assets are in the trust, they are completely protected and outside of your estate.
Great. Well, thank you so much for that, Jordan. Just in the key factor here that we really want people to know is that you're not alone in this journey. We are a team. We have a full team that's behind us. We can work directly with your accountants, if you already have your own estate planning attorneys, we're going to work alongside them. But we'd love to have you to call us. For those who are listen only mode, my personal cell phone number is 813-807-0391. I'm going to go ahead and stop the recording, and we're going to pause momentarily to see if someone has some information that allow you to come offline and ask us. Let me go ahead and pause the recording.